Hi all. Last week, Lok Sabha saw the passing of taxation and other bills recently in economy. As we are all people who use UPI in our daily lives, this certain bill has some concerns with UPI transactions that we use in our daily life. That will be the first current affair that we will be seeing today. And there was also a monetary policy committee meeting on 3rd, 4th and 5th of August, and it has come out with its decision of unchanging the repo rate and keeping it stable at 5.25%. Hi all, my name is Irene Maria Anthony. This is weekly current affairs session on economy by Amrita IAS Academy. Let's dive deep. Last week, Lok Sabha saw the passing of Taxation and Other Laws Amendment Bill. So, it is basically an amendment to Payment and Settlement Act 2007. So, Payment and Settlement Act is basically the act that makes sure that all our electronic money transactions are safe, secure and digital. That is the primary mandate of Payment and Settlement Act 2007. So, via this Taxation and Other Laws Amendment Bill, we are trying to introduce some amendments to the Payment and Settlement Act 2007. So, primarily why it has been in news is because there has been some discussions on merchant discount rate. Merchant discount rate or MDR. So, we'll see what MDR is and how it is going to affect us. And the Taxation and Other Laws Amendment Bills have some connection with our day-to-day UPI transactions that we are doing. So, merchant discount rate is not something new. It had existed in our economy. So, with this act, with this Taxation and Other Laws Amendment Bill, we are trying to reintroduce this Merchant Discount Act into the picture. So, basically, we'll first see what merchant discount rate is. Merchant discount rate is a transaction fee. To simply put it, it is basically a transaction fee on any digital payment. It is a cost of processing digital payments. So, when we are making a payment digitally via a UPI transaction, be it Google Pay or Paytm, there is a charge that is being made on this digital transaction. But it is not the customers, but rather it is the merchants who are paying this fee. That is why it is known as merchant discount rate. It is a fee that acquirers charge business in exchange for enabling and processing card credit payments. Previously, it existed for card and credit payments, and now the government of India is trying to introduce it on UPI transaction. We all use UPI transactions, and with the growing reach of UPI transaction, even though UPI transactions are of small value, they have increased in their volume or quantum. So, the quantum of transactions are very large, even though each transaction is of very minimum value. Here, with this act, government is trying to introduce. So, merchant discount rate, if we are to look at the pictographic representation of the same, here the customer pays any merchant or a shop using a debit or credit card or UPI, using a UPI, be it, for example, let it be GPay. And here, once we are making a payment, the cash, it will be deducted from our bank account and it will be credited to the bank account of the merchant. So, in this process, when a payment is made from customer's bank account to the merchant's bank account, merchant has to pay a transaction fee to the bank. So, it is basically, say for example, if we are making a transaction worth 2000 rupees. We are making a transaction worth 2000 rupees to some restaurant. And if 2% is the merchant discount rate, once we pay 2000 rupees, what the merchant receive will be somewhere around 1960 rupees, 1960 rupees, because a 2% merchant discount rate will be charged on this transaction. We don't have to pay it from our pockets, but it will be charged from the merchant side. So Reserve Bank in recent years, they have explored the feasibility of introducing MDR on UPI transactions. As I told you earlier, it is not a new thing. It is a reintroduction of merchant discount rates. And why there is an amendment to the Payment and Settlement System Act is because Payment and Settlement System Act, it prohibits banks and payment system providers from levying any charges on UPI and RuPay debit card. So as per this Payment and Settlement System Act, PSS, we are not able to charge a transaction fee on UPI payments. So basically all our transactions that we do now, they fall under zero MDR regime. Because whatever transactions we make these days, they fall under the limit of PSS Act 2007. And now with this new law, the new law of Taxation and Other Bills Amendment 2026, there has been an amendment to Payment and Settlement System Act. So based on the Act, the Act amends Payment and Settlement System Act 2007 to dealing it from Income Tax Act 1961. That is first thing. And the Act enables government to charge a transaction fee on the UPI payments. So here the government will be able to charge something on the UPI transaction. So given the large volume of transactions, the government will get a substantial sum from the UPI payments. But as per the informations that are available now, not all the charges, not all the transactions will be charged, but only those transactions which are of value greater than 2000 rupees will only be charged as per now. So basically it empowers central government to notify payment modes or transactions that must remain free of charge, introducing flexibility in zero MDR regime. There is a flexibility that is being introduced with this new law. So if the government wants to introduce a fee on UPI transactions, so government can introduce, because there is a flexibility that is being provided with this new law. That is one thing. And with this new law, there is extension of income tax exemptions to foreign companies engaged in contract manufacturing of specified electronics goods under FY 2040-41. It means that contract manufacturing is a process where foreign companies, they come to the country, they make agreements with the domestic local manufacturers, and these local manufacturers manufacture the products for the foreign companies. So there are contract manufacturings that are happening here. So basically it enables foreign investments in the local manufacturing sectors. So based on this act, there is income tax exemption given for such contract manufacturing for certain electronic goods like maybe mobile phones or laptops. For such electronic products, there will be tax exemptions. So under this law, foreign investment is actually promoted. So foreign investors will be incentivized. So once they come, they don't have to pay taxes. So that they'll see as an incentive. It will be a benefit for them. So definitely they'll come and invest in our local manufacturing units. That is one thing that this law brings out. And second thing, the bill provides process certainty to make it easier for overseas cloud companies to use data centers. We in recent years, we have seen news where we are promoting data localization. That is, the government is telling people, don't store our data outside India. Try to store those data inside India. We will provide you facilities, we will provide you infrastructure so that you can store these data locally, but do not take this data outside, store it within the country. So data localization is one of our broader objectives, and this bill provides process certainty. Now we will see what process certainty is. Process certainty is providing clear, legal and predictable ways in which the procedure is done. It is basically telling you that these are the ways in which this is done. So it is a clear-cut instruction. These are the only ways in which this is done, and there is no uncertainty or ambiguity regarding any procedures or process. And why does this help data localization? See, when foreign companies or foreign investors, they are coming and deciding to set up their data storage centers in India, they have to be very clear about the tax legislation, how things are being done, or what are the payments or fees that they are to pay for to the government. All these things, it should be very clear to them. There should be no ambiguity surrounding these procedures. If there are ambiguities or uncertainties concerned with these procedures or process, what will happen is the investors, they won't be very much interested to come and invest here. They won't be very much interested in setting up their data localization centers in India. So, according to this law, we will provide them with process certainty. We will tell them that these are things that we are going to charge upon. These are the provisions that you can do. These are the provisions that you cannot do. All these things will be made very clear to them, so that they are very clear on how they should operate their functions in the country. So that will actually make their work more easier. They don't have to go through the hassles, paperwork and all. So it will effectively make their work very easier. So that process certainty also we are providing through this Taxation and Other Laws Amendment Bill 2026, so that more and more investors will be, more and more players will be incentivized to come and set up their data localization centers in India. So that was the first current affairs. And on 3rd, 4th and 5th of August, we had Monetary Policy Committee meeting, and Monetary Policy Committee decided to keep the repo rate at 5.25%, which is unchanged. So now we will see what MPC is, what repo rate is, and why 5.25% rate is kept at this very same level. So, Monetary Policy Committee is basically a meeting which is headed by RBI Governor. There are total 6 members, 3 people from RBI and 3 people from government. So, Monetary Policy Committee is a committee that meets every 2 months. There is a bi-monthly meet. So, normally there are 6 meets in a year. It shouldn't be less than 4. That is the law. So, Monetary Policy Committee basically decides upon the key policy rates. Key policy rate being repo rate. So, why is the RBI very much keen on deciding on repo rate every 2 months? Basically, we have to go back to the functions, base functions of RBI. RBI is primarily mandated with monetary policy stability or price stability in the country. The primary mandate of RBI is price stability. So, price stability is the primary objective. If we look at the preamble of the RBI, the primary mandate is price stability with growth objectives in mind. So, in order to keep the price stable, we have to have a constant monitoring of repo rate. So, now we will see what repo rate is. Repo rate is basically the rate at which central bank of a country lends money to commercial banks in the event of any shortfall of funds. So, as we know, RBI sits at the center of the financial banking system. So, every bank comes under the supervision and monitoring of RBI. So, if the banks, they do have some shortfalls of funds, they don't have some funds to meet their daily requirement. Suppose this is the bank and this is RBI. Now, when the bank is short of any fund, they'll go to RBI. They'll request some funds. Okay. And RBI will give fund. In return for this fund, they'll take some collateral. Usually these collaterals are government securities. and in return for this collateral or security, RBI will lend money to bank at a certain interest rate. This interest rate charged on money being lent to the banks is called repo rate. So, RBI will lend money to bank in return for the government securities at a certain interest rate. An interest rate is charged on this money that is lent to banks by RBI. This interest rate is known as repo rate. So, repo rate is basically the interest rate charged on funds that are given to the banks by RBI, and RBI take government securities as collateral for this funds. So, basically this is a very short term mechanism. Usually the banks, they will have some shortfall for a day or two, and banks will run to RBI, take some money and give back securities, and once their need is over, RBI will give back these securities to the bank and take the money with an interest rate. So, banks will pay back the principal amount plus an interest rate to RBI. So, this is the whole mechanism of repo, and the rate at which this is charged is known as repo rate. It is basically used by monetary authorities to control inflation, and this repo rate is fixed by monetary policy authorities. Now, we will see how repo rate is used by monetary policy authorities to control inflation. Monetary Policy Committee is none other than our RBI. Now, we will see how repo rate is used by RBI to control inflation. So, when suppose there is high inflation in the economy. So, with high inflation, there will be so much money in the market, there will be so much money circulating in the market, and we have to absorb a proportion of this supply of money back to the RBI. There is so much money, like assume that there is maybe like 5,000 crores in the economy. This is an excess of money supply. We don't need that much for the economy. That is not very healthy for the economy. So, the RBI, they are deciding to absorb some money. They are trying to reduce it to maybe like 4,000 crores. So, we need to pull back some of the amount. How we will do it? Now, RBI will increase repo rate. Okay, repo rates will be increased. This will automatically increase the interest rate of banks. How? Once RBI increases repo rate, banks will find it costlier to go to RBI and take loans. Previously, if it would have been like 4%, for every 100 rupees that the bank is lending from RBI, they had to pay 104 rupees back. But now, with the repo rate change to 5%, there has been an increase in repo rate. Bank has to pay back 105 rupees for every money they are lending out of the RBI. So, this is an increase in cost. This is an increase in cost. If we are looking from the perspective of the bank, there is an increase in cost in their operations. So, what will bank do? Given that there is an increase in cost, they will lend less. So, if previously the banks were lending somewhere around 100 crore and all, because there was a lower repo rate, now the bank will be reluctant. They will be lending somewhere around maybe like 50 crore because there is an increased cost. So, with lesser lending, bank will have a less amount with them. Previously, there was a lower repo rate, bank was lending 100 crore. At 4%, bank was lending 100 crore. Now, it is 5%. So, with higher cost, bank is trying to cut down its costs and they are lending 50 crore. So, what liquidity available in the bank has now reduced. So, what will the banks do? Banks, they will charge a higher interest rate on the loans that they are providing from the bank. So, previously if the interest rate was 8.25% on the loans, their loans, they will now try to charge somewhere around 9%. So, there has been an increase in the loans that are being provided by the bank. So investors are the ones, basically investors are the ones who come to the bank to take loans. So given that there has been an increase in interest rate, less number of people will come to the bank to take loans. So this will automatically reduce the quantum of loans that are flowing into the economy. That is one aspect. Now, there has been an automatic rise in interest rate in the economy. So, this will also pull more savings into the bank. People will be interested in putting money in the bank because there is higher interest rate that I am getting from the money that I put in my bank account. So, there are two aspects to it. One is now with a higher interest rate being charged on loans, there will be lower quantum of loans that are flowing into the economy, and with higher interest rate, people will be incentivized to bring money and put it in the market. So, RBI will effectively reduce the quantum of loans, one thing, and second thing, people who have money, they will also be interested to put their money in the bank. So, effectively in the long term, with n number of banks working in the system, we will eventually pull out this extra 1000 crores from the economy, and that is how inflation will be contained when there is a high inflation in the market. If the case is vice versa, if there is a low inflation in the market, in a very similar fashion, money will be pushed in the economy so that the inflation is at the optimal level. So, this is how repo rate will effectively come into reality on the ground level. So, these were the two current affairs that are discussed today. MDR was once asked in prelims. Merchant discount rate, there was a question on prelims in 2018. There was a direct question on MDR, and repo rate, reverse repo rate, its related concepts, money and banking, it is one of the favorite concepts of UPSC. So, I hope this helps. Thank you.
Amrita IAS Academy.